Welcome to my channel world. See news, subscribe to my channel for news updates all around the world. In July 2024, Beijing sent a clear message to its top carmakers: stop all new investments in India. This directive came as a shock to many, given the recent surge in Chinese investments in the Indian automotive sector. The Chinese government, known for its strategic economic decisions, seemed to be taking a hard stance, prioritizing political considerations over economic gains. This wasn't a subtle hint, it was a public directive to giants like BYD and Great Wall Motor, halting their ambitions in one of the world's fastest-growing markets. These companies had been eyeing India as a lucrative opportunity, with plans to establish manufacturing plants and capture a significant market share. For years, Chinese automakers have expanded globally, and India, with its massive population and rising middle class, was the next big prize. The Indian market, with its growing demand for affordable and efficient vehicles, presented a golden opportunity for these companies to expand their footprint and increase their global influence. But Beijing's advisory has slammed the brakes, redirecting billions in potential investment elsewhere. This sudden shift has left many projects in limbo, with construction halted and business deals canceled. The ripple effects of this decision are being felt across the industry, as companies scramble to reassess their strategies. The timing is telling. As China's export growth slows and global demand cools, the move signals that political risks now outweigh economic rewards. The Chinese government appears to be recalibrating its approach, focusing on mitigating geopolitical tensions rather than pursuing aggressive economic expansion. This isn't just about business, it's a geopolitical statement. The directive underscores the growing tensions between China and India, two of Asia's largest economies. The strained relations have now spilled over into the business realm, affecting industries and markets on both sides. The fallout will reshape where cars are made, who profits, and which countries become the new automotive powerhouses. As Chinese investments pull back, other nations may step in to fill the void, potentially shifting the balance of power in the global automotive industry. Chinese companies must now rethink their global strategies, while rivals see a rare opening in India. This unexpected turn of events has created opportunities for other international car makers to strengthen their presence in the Indian market, capitalizing on the gap left by Chinese firms. What we are witnessing is more than a corporate retreat, it's a pivotal moment in the global auto industry, with India at the center. The decisions made in the coming months will have long-lasting implications, influencing the direction of the industry for years to come. The world's automotive map is being redrawn, and the stakes couldn't be higher. Companies and countries alike are watching closely, as the outcomes of these strategic moves will determine future leaders in the automotive sector. The next chapter in Asia's economic rivalry has just begun. As the dust settles, the true impact of Beijing's directive will become clearer, setting the stage for a new era in the automotive world. In China, a government advisory carries the weight of law. Even if it's not technically a ban, the Ministry of Commerce's guidance isn't enforced by police, but no major Chinese company would dare defy it. This window guidance freezes new investments, research centers, and factories in India. Beijing maintains plausible deniability, framing the move as caution, not aggression. The message: stick to simple assembly, avoid deep manufacturing, and minimize exposure. In practice, the flow of Chinese auto investment into India has stopped cold. Projects are shelved, strategies rewritten, and a real barrier, just as effective as any tariff, now divides the two markets. The competitive landscape in India's car industry has fundamentally changed. China's move didn't come out of nowhere. It's the result of years of rising tensions between the two Asian giants, rooted in a complex history of disputed borders, military standoffs, and shifting alliances. The relationship has always been uneasy, but recent years have seen a dramatic escalation. The 2020 Galwan Valley clash between Indian and Chinese troops marked a turning point, spilling over into trade and investment. The violent confrontation, which resulted in casualties on both sides, shocked the world and shattered any illusions of stability along the Himalayan frontier. In response, India moved swiftly to tighten its economic defenses. New rules were introduced. Any investment from neighboring countries, especially China, now needs direct government approval. This was a clear signal that economic security was now inseparable from national security. This policy created a formidable barrier, chilling Chinese investment across sectors. Chinese tech giants, manufacturers, and even startups suddenly found themselves locked out or facing endless red tape. Major deals like Great Wall Motors' billion-dollar plan and BYD's EV factory were blocked or abandoned. The message was clear. India was no longer an open door for Chinese capital, no matter how lucrative the opportunity. Yet, paradoxically, China remains India's top trading partner, with trade hitting record highs. The relationship is deeply imbalanced, with India importing far more than it exports, fueling a persistent and growing trade deficit. India imports vast amounts of Chinese goods, from electronics and machinery to chemicals and toys, making it difficult to reduce economic dependence despite political tensions. Economic ties run deep, even as political mistrust grows. Indian businesses rely on Chinese components, and Chinese companies see India as a vital market, creating a web of interdependence that's hard to untangle. China's investment ban is just the latest move in a long, complex rivalry. Each side watches the other warily, knowing that every economic decision is also a strategic one. Both nations are rivals and partners, locked in a high-stakes economic chess match where every move is calculated and the stakes keep rising. The border may be icy, but the competition is red-hot, and the outcome will shape the future of Asia for years to come. For Chinese automakers, India is now a minefield. Investment approvals are slow and uncertain, deterring long-term plans. Companies like MG Motor have had to partner with Indian firms, sacrificing control just to survive. Sky-high import tariffs make selling Chinese-made cars in India nearly impossible. Local manufacturing is required, but nearly unattainable for Chinese brands. Even assembling cars in India is tough, with pressure to localize parts in a still-developing supply chain. The message is clear. For Chinese automakers, India is a closed shop. While China steps back, India's auto industry is surging. Last year, India produced 5 million passenger vehicles and exported 800,000, a 15% jump. Government incentives, low costs, and a skilled workforce are fueling this boom. The Make in India initiative has turned the country into a global export hub. Domestic demand is rising, with Indian brands like Tata and Mahindra challenging global giants. Competition is fierce, driving innovation and quality. India is no longer just a market, it's becoming a global automotive force. As China's automakers hit a wall, Japanese giants are racing in. Toyota, Suzuki, and Honda are investing nearly $11 billion in India, shifting focus from China. Suzuki, through Maruti Suzuki, is doubling capacity to 4 million vehicles, aiming to make India a global export base. Toyota is expanding to over 1 million cars a year, launching new models and betting big on India's growth. Honda is making India a hub for its next-gen electric vehicles, exporting them across Asia. For these companies, India is now a top global priority. This investment wave is transforming India into Asia's new manufacturing powerhouse. The winners are clear, and they're betting on India. Despite India's ambitious push for self-reliance, its auto industry, especially the rapidly growing electric vehicle sector, remains deeply dependent on Chinese parts and technology. Even as the government champions the Make in India initiative, the reality on the ground is that Indian factories still rely on a steady stream of components shipped from across the border. Over a quarter of all auto components imported into India come from China, making it the single largest source of parts for Indian automakers. These imports range from basic hardware to highly specialized electronics and battery cells, all of which are crucial for modern vehicles. For electric vehicles, the dependence is even starker. An astonishing 93% of rare earth magnets used in EV motors are sourced from China. These magnets are essential for the powerful, efficient motors that drive the EV revolution. In 2025, when China imposed strict export controls on these magnets, it sent shockwaves through India's EV sector, causing delays, uncertainty, and a scramble for alternative suppliers. This isn't just a supply chain issue, it's a matter of strategic leverage. China's dominance gives it significant influence over the pace and direction of India's automotive ambitions. India is racing to build its own supply chains, investing heavily in research, new factories, and local talent. But developing the expertise and infrastructure to match China's scale and efficiency will take years, if not decades. Meanwhile, Japanese and Indian cars rolling off assembly lines in India still contain many Chinese parts, from semiconductors to sensors, making true independence elusive for now. The economic destinies of these two Asian giants remain tightly intertwined, with billions of dollars in trade flowing between them each year, especially in the auto sector. No matter how high the investment walls or how strong the political rhetoric, China's influence lingers in every Indian-made car, visible in the parts that power them. Achieving true independence will be a long journey, one that will require patience, innovation, and a relentless drive to build a self-sustaining ecosystem for India's automotive future. The China-India standoff is redrawing the global auto map. Japanese automakers are the big winners, shielded from Chinese competition and free to dominate India's vast market. India gains jobs, technology, and a shot at global manufacturing leadership. Domestic champions like Tata and Mahindra also benefit, with more room to grow and innovate. Chinese automakers, locked out of India, face a major setback in their global ambitions. The world's supply chains are shifting. India is rising as the top alternative to China. But this could also mean more regionalized markets, with different standards and less consumer choice. The era of a single China-centric supply chain is ending. A new multipolar manufacturing world is emerging. The stakes for global industry have never been higher. India is closer than ever to becoming a global automotive hub. Government support, a booming market, and massive Japanese investment have set the stage. With Chinese brands sidelined, India has a rare window to lead, but challenges remain, especially dependence on Chinese components for EVs. Building domestic supply chains for batteries and electronics is urgent. India must also keep policies stable and infrastructure strong to stay competitive. The world is watching as India and its partners reshape the industry. If India can overcome its vulnerabilities, it could claim a seat at the head of the global auto table. The journey won't be easy, but the opportunity is real.